we have Tim Edwards. Tim is Managing Director for Index Investment Strategy at S&P Dow Jones Indices. In that role, Tim helps produce research and commentary about the firm's indexes. Prior to that, he worked at Barclays Capital on exchange-traded products and index-linked derivatives. Next to him, we have Sanjay Rao. Sanjay is Product Manager for Bloomberg Barclays Indices in Europe. Prior to Bloomberg, Sanjay was a director in the Index Portfolio and Risk Solutions team at Barclays, where his primary focus was on the research and development of fixed income indexes. And to his right, we have Emanuele Bellingeri, Head of Asset Management for Italy at Credit Suisse. Emanuele joined the firm earlier this year after more than a decade at BGI, later BlackRock, most recently as Head of iShares for Italy. Thank you all for joining us. So you'll have noticed a certain rhythm to proceedings, other than my terrible cough, in that we're going to have another poll to get the conversation started. So the question this time is, which asset class has the most room for index innovation? That's which asset class has the most room for index innovation. As you can see, we've got four potential answers for you there: equity, fixed income, commodities, and alts. Now, unless anybody has no opinions on this, we should start to see some of the bars come up. All right, fixed income is very much in the lead. Let's see if we can get some debate out there. So I'll give you guys a few more seconds to weigh in on this. I'm surprised that alts hasn't got a bid yet. That's always an interesting one. So far, 50-50 fixed income equity. Hey, alts getting a little bit of a ride there. All right, commodities is not loved. Oh, there we go, finally. Okay. Well, that's an interesting kind of like place to begin. Equity is still very much in the lead. Interesting. All right, okay. Well, given that we have now 3.7 million indexes worldwide and more than 400,000 were actually created in just 12 months, I think it's kind of an interesting sort of to look at this and kind of see, actually, most of the index innovation that people currently expect to come is coming from the equity side. Tim, is that how you guys see it at S&P, or are you seeing kind of index innovation coming from another direction as well?
I think that's perhaps fair. I would speculate that a good chunk of the people who are voting for equity probably have certain themes in mind, which would probably include ESG. So this is an area that we and other index providers, asset managers, are on a journey that is not yet finished, and there's a lot of demand, certainly from our clients, for innovation and for a clearer path for them. I think alts might be undervalued in the sense that the use of indexing, or the ability to index outcomes. The European market has always been a market in which structured products are a big piece of the pie, very often in order to ensure certain outcomes. One of the more interesting developments is we've worked globally with ETF providers to actually launch ETFs that have essentially structured payouts. It's very small, it's very new, but it's an interesting space of innovation.
Interesting. Emanuele, where do you think there needs to be kind of like more indexes? Like, do you think that we have sufficient now, or is there room in certain areas?
No, I just would like to reinforce the message for the panel before regarding fixed income, because if we consider only 1% of fixed income investments are through ETFs or index mutual funds, I do believe we'll see more growth for in this asset class. And we have also to consider we are in an environment with very low interest rates, and just we had the confirmation this week with the Fed release. Will stay for additional time in this environment, so people searching for yields. Sometimes you have good capabilities imaging government bonds and fixed income more broadly, and you need to add high yield emerging markets bond and so on. So I see good growth there, both in indexing and in asset under management. And then I see also a niche part of this asset class, which is the multi-asset portfolios, because we have just seen for multi-factors, so starting to combine different, let's say, exposure. I think also considering the development of the models in the US, which will come also in Europe. I think we can see a good growth also in this space.
Interesting. So fixed income and multi-asset. Sanjay, I want to pick up on fixed income first, because obviously this has been an area of specialty for yourself. Why do you think there is so much demand for innovation in fixed income indexes? Is it changing use of these products? Is it the inadequacy of some of the earlier indexes? Like, what's been kind of like the big push?
And from my perspective, I've been in indices for longer than I'm actually willing to admit now. And historically, I've always seen that the conversation has been, if equity is the digital age, then fixed income is definitely the analog age. And we seem to be slower at reacting and producing new products. I think that's primarily a function of the asset class itself. There's more securities to deal with. If you think about the one listed JP Morgan bond equity versus 10,000 bonds. Then there's also liquidity, transaction costs and all that. So it makes it much more difficult to replicate a strategy. So while the equity world has been more capable of developing new ideas and then creating them and then launching them, I think for fixed income, being able to actually have a product that is both replicable and representative is very, very difficult. What we've seen, though, is that what's worked in equity is they've looked for a translation into the fixed income world. So one of the key things that we've seen is ESG coming through, where people who, asset owners who have created ESG equities products, they've wanted to shift that over onto the fixed income side. So, that it's been a slow process. I think 5 years ago, we launched our ESG family. 5 years ago, you'd go to a conference where the equity house would basically sponsor the conference on ESG and tell everyone about how they were producing new products. Then you go to the fixed income portfolio manager, and he had no idea what ESG was. So I think fundamentally, the fixed income people have been learning from the equity people. And similarly, in terms of innovation, what we're seeing is the growth of interest in multi-factor. So we've done some research and published a piece on the implementation of value, trend, carry as strategies within fixed income. And the key discussion point that we've had with clients, though, is that the absolute return number, or the gross return number, isn't something that's achievable. So you need to incorporate transaction costs, and that can over the pricing cycle as well. So it becomes a much different return and a different allocation, and it's a different conversation from the equity side.
Tim, I want to bring you in now. Maybe you have some thoughts on the fixed income side as well, but I also wanted to talk to you about the multi-asset side of things, because Emanuele brought up a very interesting point there. That obviously it has some challenges to it. So how do you think about creating an index that isn't just equity or fixed income or alt, but kind of combines some of these into one investable product?
Yeah, I mean, it's astonishing to me that we launched a risk parity benchmark within the last 12 months. This is an incredibly popular strategy. How has it not had a benchmark for so long? I think the challenge for the index providers was manifold. It would often be the case that the market would like one index provider for perhaps emerging market bonds, another index provider for US bonds, and so on. And so in practice, they were using different index providers to construct their multi-asset. So I think that was one sort of practical problem. I think the other piece has been that the client base has not really wanted that kind of structure in the tradable product. It's a very common use case. So target date, for example, will be buy and hold, not so much buy and trade. But just to pick up on one last point, going back to innovation, I think that the real innovation that's going on in our space is not actually in terms of the new indices and the new products. The real innovation is in the user base. So we've had one of our most popular indices, the Dow. That was launched in 1896, and it's still popular today. What's changed is the user base. It's who's using it and how are they using it. In terms of retail, it's coming from the periphery to the core, and in terms of institutional, it's in terms of portfolio tools that potentially also come in at the core. That's the real innovation that I think our indices are helping. That's
a great point. And Emanuele, it brings me to ask you, how has the way that asset managers actually think about indexes evolved? Tim mentioned that there's been a change in how kind of users think about these. From your perspective, has this been a move from using them as benchmarks for performance to something that you can pin a product to? How do you think about that?
Yes, maybe I can bring the experience here in Italy because we are here in Milan. So what's happened in the past was to use the benchmark just to overperform them, especially for long-only active mutual funds. On the other side, if we consider fund of funds and discretionary portfolio, so what we call it here GPF, which are basically discretionary mandates with funds as underline, the goal of the fund manager was to pick the right funds to add value. So we can talk more about fund analysts or fund selectors rather than portfolio managers. Now there's been a big shift towards an asset allocation product. This is also due to the fact that the MiFID and the regulators in general here in Europe and in Italy as well go for lowering the pricing, the total cost of the product. So portfolio managers are using a lot indexes instead to mutual funds, trying to seek alpha from asset allocation rather than or complementary to fund selection. We had a generation, let's say, of portfolio managers here in Milan, in Italy, just focus on the fund selection, and it's changing a lot. So we are now talking about asset allocation.
Interesting. Sanjay?
So one point on that, I think a lot of the conversation has used index as a synonym for passive. And I think it's important to recognize that the index itself is just to define what the investable universe is for a particular asset class. It's the universal playing field that everyone can then use to assess whether an active manager is outperforming or a passive manager is effective at providing the beta. So the first challenge is to define what your asset allocation is, and then you define what the index is. So I think it's important to remember that distinction.
Yeah, and that brings me to another point, just about kind of how the construction of indexes and benchmarks has been changing over time. If we think about kind of the tools that are at disposal today, you have artificial intelligence, machine learning, natural language processing. Tim, perhaps you can weigh in on that. How do you guys think about some of the advances in technology and how that can help when creating indexes?
Yeah, I mean, it's definitely, well, to me, it's fascinating as something of an index nerd. So we have, and now as part of our range, used AI and all these tools, natural language processing, to actually define and select companies exposed to certain themes. I think that there's definitely some hyperboles and some stuff about AI that maybe won't quite deliver on its promises. But as a tool, as a set of processes that can improve things like country classification, sector classification, company classification, I think that increasingly these will become part of the process, and they will enable us to do certain things. If I might just add one warning on AI. So one of the things that people criticize companies for is sort of engineering to a backtest, building something that looks perfectly, works wonderfully well in history, but only because we sort of kept trying things until they worked. AI and the computing power that comes with it is a huge opportunity to create perfect Sharpe ratio, historically backtested indices. And I hope we're careful in its use. But I do think that's definitely part of it, something that's perhaps worrying. It's
going to be a bit of be careful what you wish for kind of thing. Sanjay, I want to come to you just on that because we have seen kind of thematic products, perhaps a little bit slower in Europe than maybe in the US. Athanasios had a wonderful slide in the previous presentation that showed kind of how thematic funds have really grown up over there. Do you think that it's kind of like been the sort of the time it takes to develop these AI-related products that can help identify themes that's kind of held things back? Or is there something fundamentally missing in demand over here for those types of products?
I think the demand, especially on the fixed income side, given the complexity of creating these new products and the ability to actually achieve that asset class return or whatever the value return is, it means that it's very hard to have that conversation. So I think we referenced the ESG conversation, which has taken 5 years to fulfill itself in fixed income. We're only at the beginning of that conversation on the factor indices, whereas the equity side have been doing that for multiple years. So I think AI for fixed income, like I said, if we're analog and they're digital, we're very far in the back. So I think it'll be a long time before we get that level of access. But one of the things I'd also like to highlight is that for an index, it's actually the index itself. The reason why there are single players that are very successful in a particular field, even though all index providers provide similar products, is because the index is a conversation between market participants. It's the way of defining that asset allocation or that field. So it's important that you have the discussion with clients about how they look at their asset allocation. If you take a simple example, 15 years ago, investment grade was held as a synonym for developed market. Now, with the growth of EM investing and the growth of EM countries getting higher ratings, we've seen the bleed of those countries into investment grade benchmarks. And that means that the asset allocation has been twisted slightly or changed, because you have to account for the fact that you have a separate EM allocation versus your investment grade allocation. So 4 or 5 years ago, we had the discussion with clients about how we could clearly delineate the investment grade and EM to be able to show that there's a distinction between the two. Because we all produce different indices, but like if you look at, we produce a universal that covers investment grade and high yield. But fundamentally, that's not where the asset allocation is taking place. It's across those two boundaries, and you need to delineate them appropriately.
Interesting. I want to throw back a little bit to the earlier question that we had about what's going to drive assets going into ETFs, whether it's going to be innovation, cost, regulation. Cost is something that obviously has been coming down across the asset management industry. We've seen huge pressure for the big issuers to lower their fees, and obviously some of that gets passed on to the index side. So Emanuele, I wanted to come to you on this. Just how do you guys think about choosing indexes and benchmarks at Credit Suisse? Are you looking at cost and how much it costs to license things? Are you looking at the underlying exposure? Like what kind of weighs in when you're thinking about which provider to use?
Yes, we look first at the quality and also the exposure, and if you're able to provide broader exposure and a good set of products. But about cost, I would like to make a consideration, saying that there are a lot of pressure on margins for revenues for asset managers, which are obliged to lower the cost, and if you consider the value chain, it's necessary also to see the same dynamics also for index providers or depot bank or companies providing services and tools to asset managers and to the distributors as well. If not, the risk is to find alternatives. So on that side, alternative distribution models could be to fintech or technology. And on the other side, if the index providers are too expensive, sometimes you need to find alternatives, maybe self indexes and so on. So it's important all the value chain understand this trend in reducing margins.
Yeah, the self-indexing trend is a really interesting one. We've certainly seen a lot of it in the US, just issuers themselves creating indexes using their own proprietary research, because it means that they can cut down on that fee. They don't have to pay any money going out to an index provider, and they have control over that, the specifics of the index. Tim, how do you sort of see this kind of trend? Is it a threat to your business or not?
Well, I would certainly say that competition in the indexing business is very vibrant at the moment. I think there are distinctions that can be made. I think people underestimate how much work goes into building an index, just the vast number of people that we have monitoring every corporate action and all the different pieces that go into publishing an index. But more than that, I think there is, some index providers will provide a lot of research, potentially marketing support to their distributors. And I think finally what I would say is, why use an index? Part of it is transparency. Part of it is knowing what you get. But a big part of it, and especially when it comes to ETF, is liquidity. And you might understand the price that you get in, but what helps you feel confident about the price that you get out? If it's an ETF linked to the S&P 500, what you can rely on is not only the vast number of people in the whole market that's watching this index, but also the ecosystem, futures, options, and so on, that help, everyone has a view on the 500 and it's priced very efficiently. So it's not necessarily just about, getting the index right and on time. It's also about the ecosystem that has built up around, particularly a few indices.
Interesting. I wonder whether any of the regulatory kind of shift that we've seen recently with the benchmark regulation kind of coming in has changed sort of how easy it is to innovate, and whether indexes in fact have more sort of requirements on them, makes it harder to be an index. Sanjay, I know you've been following kind of just the ebb and flow of the regulatory landscape fairly closely. I mean, what's your sense of how it impacts indexing?
Well, I think one of the basic requirements on UCITS is that any index that's created for a product must be broadly used and broadly available and can't be defined by one or two clients. So the idea that self-indexing is an option, potentially that there could be a discussion with the regulator, but that seems to preclude that specific thing. But to Tim's earlier point, the idea that an index sits at the center of the asset allocation process between asset managers, asset owners and consultants in defining what they're doing. It's the conduit to have that conversation. And if you think about that, then self-indexes is sort of a monologue. It's just the person's talking to himself, right? So you need that conversation to understand what's going on. I think the proliferation of different index providers using different products is potentially an issue, but the question is that they're trying to define what the market understanding of a particular asset class is. And that does need to take place for everyone to benefit. If you think about the way that fixed income has gone, 30 years ago it would take like 10 days to calculate a monthly return. And it's with everyone coalescing around a particular type of product, they've developed new tools, they've learned how to distribute effectively, and that's been an advantage to grow the market. And I think that's important with this.
Yeah, I want to turn now just to think about some of the risks around indexing and index products in particular. One of the big concerns, and I think this might chime particularly well, given that we're in Milan, is just about kind of the debt markets and whether indexing in liquid markets like bank loans could potentially be problematic if we do kind of run into some serious market trouble. Emanuele, how do you think about this? Do you feel comfortable using index products or using indexes for fixed income instruments?
Yes, as I mentioned before, index funds and ETFs wait only for 1% of the total investment in bond, and for some asset class there is 3% mainly. If you talk about high yield and emerging market bonds, so we are very, very low weight, and so they don't affect the liquidity. And on the other side, they are really important for a price discovery topic, and also are really reliable because they are. So you have these baskets of bonds really traded. And not only just priced by some providers. So I think it's the opposite. There are some detractors trying every time, but then when there are some liquidity issues in the market, ETFs pass the exam really, really well. So.
Okay, so not big enough to really cause an impact, and also potentially the benefits of actually seeing some kind of transparency on price. Sanjay, do you agree? Like, how do you think about it in construction, just actually sort of making sure there's enough liquidity within those indexes? Well,
I think that's the key issue for a good index. The idea is it should be representative but also replicable. Right. And the replicability has to happen across all cycles. So, sovereign wealth crisis or the bank crisis, you need to be able to get pricing. And what we've seen is that can be very difficult, but you have to make a judgment because it adds value to be able to publish something that allows for people to look at the price. But so I think when we go into loans and things like that, then it becomes more difficult, but with enough due diligence and going back to large providers having the scale to be able to provide the data, the pricing, the analytics, and the research and distribution, that's what the value add that we produce are. And I think as more information comes available, we become better at producing more indices.
So if I could add, so there's clearly some risks and some benefits. The risk, and I think we heard this quite clearly in the earlier panel, just because something is liquid today doesn't necessarily mean that I can always rely on it being as liquid. But ETFs and indices have been through some pretty good stress tests over the last 20 years or so, 25 years, I believe, since the ETF kind of came along. One example that I thought was really illustrative was actually the Greece ETF. So a few years ago, the Greek equity markets closed. There was a Greek ETF linked to those equities that naturally then could not, increase or decrease its scale by accessing the local markets. The existence, that ETF became more illiquid, but it was still much more liquid than Greek equities, which didn't trade, and actually gave the rest of the market an indication for where that pricing should be. So I think, clearly there is a risk that just because something is liquid today doesn't mean it will always be liquid. But the existence of tradable products can improve price transparency, and on a relative basis can improve liquidity.
Yeah, I always like the sort of analogy of almost like a kind of pressure valve that you can kind of like go into the ETF and trade that before the underlying necessarily has to trade, which kind of helps things out. I think your microphone might be going in and out. Well, it's good because we've got 1 more minute left. So I wanted to ask you guys to finish up with about kind of the limits of indexing, whether there are any. Like we saw on the poll that people weren't too interested or optimistic about the innovation in commodities or alternatives. Those are obviously some of the more challenging areas to index. Perhaps in turn, and relatively briefly, as we are running out of time, what do you guys think are kind of the potential limits for indexing? Emanuele, do you want to start?
I agree with Sean at the beginning, so I think we have to stay to the core and more liquid benchmarks or indices.
I think commodities is primarily an inflation hedge, so keeping it clean or simple is easier. On the alt side, again, data. How would you know what you were indexing? So I think it's a valuable request, but there's no underlying.
There will always be parts of the market. Sorry, there will always be parts of the market that we can't index, but there is still rather a lot that we can.
Okay, so an optimistic outlook for more indexes and more index products from these guys. Thank you very much to my panelists. Please join me in giving them a round of applause.